Joining us right now with more on the markets is Jim Paulsen. He is former chief investment strategist at the Luthold Group, also at Wells Capital Management. He's now the author of Paulsen Perspectives and, of course, a longtime friend of the show. And, Jim, it's great to see you this morning as we are closing out the last day of the year. I guess I wonder what you think things are setting up for 2025.
Well, Happy New Year to you, Becky and Joe. Thanks for having me this morning. I think that we might eke out another positive year, the overall market, but I think it's going to be a lot bumpier ride here in 2025. And I think we're due for a correction, probably maybe in the first half. We haven't had one, about a year and a half now, and we're due for one. I think there's a lot of optimism. The GDP is at 3% on the GDP Now number for the fourth quarter, 2.7% year on year. The Fed has paused or at least slowed its easing campaign because it thinks almost the economy is too strong. Bond yields have backed up a lot because they share the sentiment. I think the opposite's going to be the issue. I think the economy is going to slow fairly significantly here in the first half. There's a lot of tightening force, even though the Fed's easing. Bond yields have backed up a full percent. Mortgage rates are up over that period of time. The dollar's been really strong, up maybe 6 to 8% real dollar terms this year. And money growth, while it's rising, is still a little over 3%. Nominal GDP is 5%. That just is insufficient money growth for the current growth rate. Typically, when money growth is less than nominal GDP growth, the real GDP decelerates in the coming year by almost 1% going back to 1960s. So I just think the combination of those tightening forces is going to slow the economy down to about 2%, Becky, or maybe less. And I think that's going to reignite recession fears, even though I don't think we're going to have a recession. I think we're going to be worried about it again. And with that, I think we could get a correction in the stock market. The good news is if all that kind of plays out, then it'll open the path for the Fed to ease again.
That's what I was going to say. If there is a pullback because of all those factors, if the economy really does slow down, if inflation comes down, the Fed is poised to jump back in and lower rates again. So you think it'd be a short-lived correction if it happens?
I do. I think it might drag out. It might take a while for it to unfold. But I think if it does unfold, then I think it's a good buying opportunity again. I don't think the bull's over. I just think private sector balance sheets in the corporate sector and the household sector are way too strong, Becky, to really tip them over into recession. Liquidity is everywhere. Net cash flow to GDP in the corporate sector is close to post-war highs, and there's $7 trillion of money market funds on the household sector. There's still a good deal of cautiousness and pessimism underlying on Main Street. That's not a recession recipe, but we certainly could grow slowly. And with the unemployment rate already at 4.2, you can just imagine the fear that might happen if it tips up to 4.3, 4.4 about recession. And it could be punishing, sell-offs in some of those cyclical areas, and I think even maybe the tech darlings for a period of time. But I do think that will represent a good buy later in the year.
What kind of a pullback are you thinking? What would make you say, okay, this is the time to jump in? Are you talking 5, 10% or more than that?
I'm talking about a correction, maybe 10 to 15% in that ballpark. But I got to tell you, Becky, forecasting corrections is a perilous activity. Yeah. You got to call it at the front end and the rear end. I wouldn't raise cash because I still think we're in a secular bull that could last a few more years yet. And I don't want to miss that for the sake of a bump along the way. Rather than raise cash, what I do is take some of your winners that have done really well and lighten up on some of those more aggressive and cyclical areas of the market, including some of the technology. Don't sell out entirely, but lighten up and buy some of these beat up defensive sectors or other defensive things like S&P high dividend yield or high quality or the S&P low volatility stocks. And then if the market keeps running all year, you're going to participate. But if it does pull back, you're in a position then where you can go back and pick up some stuff with fear and at much better prices and reestablish more of an aggressive position again.